in this mock exercise, we're going to take a look at how we're going to utilize cost, volume, profit analysis, and we're going to take a look at a case called Fong Phone Limited. And this is a case where it allows us to showcase the difference between contribution margin, which is a style of format of income statement that is useful for internal management decision, as opposed to gross margin, which is what we often will see on financial statement reporting. Let's take a look at the question. So the question, it says that Fong Phone manufactures cell phones, and they're priced at $250, so that is the sales price. So I just like to put little words like SP for sales price. Put a little, okay. Let me make this thing a little bit bigger. Okay, now, the president has come to you for help in terms of the company's cost structure. You are troubled because the data produced by the accounting system do not distinguish between variable and fixed. After some analysis, you have identified various cost behavior patterns. You have determined that the margin of safety, so that's margin of safety, we need to know what that is. Let's call it MOS, margin of safety, is 75,000. So we're going to take a look at what that is. And the sales in break-even units are 2,700. So break-even units are 2,700. So let me highlight those two important points. Now, it says that the great part about this question is that Fong does not have inventory or does not carry inventory as one of their policy. So you don't have to deal with beginning and ending inventory. And if you did, it would obviously complicate the entire scenario. Now, instead, the company finished pending orders sometime in the summer and gives employees vacation at the end of early January of the following year. You have also collected the following information for 2012. So, you're given labor, material, variable, gross margin percentage, contribution margin percentage, and income tax rate. Now, just as a point, I wanted just to highlight for you the difference here. Gross margin is sales less cost of goods sold. Gross margin, right? And gross margin percent is gross margin divided by sales. So that's what gross margin is. Contribution margin, so let me just put a little square beside that. Contribution margin is, I'm going to put it down on this side, is sales less variable cost. Gives you contribution margin. And contribution margin percent is CM divided by sales. And that's what this is. I'm going to put a box beside that too. So completely different. Now, the other point that's different as well is, if I look at these two, this is all variable cost. All variable cost, irrespective of whether it relates to manufacturing, selling, administrating, type, activity, marketing, any of those, all variable cost. Whereas this one is all cost incurred, regardless whether it's fixed or variable, related to manufacturing. That's the two difference. Okay, two different calculation. Now, the income tax rate is 25%. So this question asks us to calculate the following. So to help Fong's management team, we have to be able to calculate the following information. So we want to know how many sales in dollars. We want to also calculate variable selling and admin expenses, fixed manufacturing overhead, fixed selling and admin expenses, and earned income before taxes. So that's what we need to calculate in this question. Now, it says determine the sales volume in units that Fong must achieve to earn $36,000 income after tax. So we need to be able to determine how much volume, what is the number of units we need to sell in both dollar and volume to achieve a target income after tax. Okay, so I just want to highlight that too. That's the second part of the required. And it's asking us for degree of operating leverage. So DOL, let me short form that. Calculate the DOL. Now, why do we need to know that? We'll see the power of the degree of operating leverage because it's asking us if sales increase by 8%, what is the impact to the operating income? To do that, we need to understand what is the degree of operating leverage. Okay, so that is what we're asked to do, and we're going to take a look at this question in a minute. Okay, so let's start answering the question. So the first part of the question is asking us for, so part A, sub 1, asking us for sales in dollars. Now, we do know that the margin of safety, so what, first of all, what is the margin of safety? So let's take a look at what that concept is. So a margin of safety essentially is one of those sensitivity tools. Now, this is from your lecture notes. So margin of safety is one of these sensitivity tools that allows us to do a what-if type of technique. And this is essentially the difference between total sales, and these are actual sales, minus break-even sales. So first of all, what is a break-even sales? So break-even sales is essentially the amount of revenues you need to sell to have zero profit. That's essentially what break-even. What is the amount of revenue in dollars that you need to at least hit, at least to achieve, and able to generate zero profit? So we're going back to our equation. Sales equals variable, in this case, we will do it this way. So we'll start with, I'm going to do it at the top, sales minus variable cost minus fixed cost, okay, equals 0. So that's the profit, isn't it? Let me put profit in here. Okay, so what we want is we want sales on one side of the equation equals variable cost, so we're moving it to the other side of the equation, plus fixed cost plus profit. And that's essentially what this equation is. That's essentially, this equation is really this equation here. Okay? So what we want is we want sales of X, okay, equals, now, variable cost is always a function of sales because we know that variable cost, if you don't sell any, variable cost is 0, right? It's a function of revenue. And this one, it represents 60% of X, means that for every dollar of revenue that we're going to generate, 60% of that, 60 cents of that is variable cost, plus fixed cost, plus zero profit. And if you do it this way, you'll find X. And this, by the way, is divide. And that gives you X equals 200,000. So that's how we calculate the variable cost. This is just an example that I did in class. It just basically says that the variable cost is 60% of fixed cost of sales, and fixed cost is 80,000. And here you can see that X is sales dollars, so that's why it's 80. And 60% is variable cost as a percent of sales, and 80,000 is the fixed cost. Now, another way of expressing a break even is essentially what is the activity, the quantity of output where total revenue equals total cost. And of course, at break even, operating income equals 0. In this case, we're using the same equations that I did before, except now we're taking profit, or sales equals variable plus fixed plus profit. Well, profit equals 0. We're looking at the number of units, right? So we need to know the price per unit, the variable cost per unit, and the fixed cost of 800, and it gives us to 400 bikes. Now, if you think about it, 400 bikes times 500 gives me 20,000. So we can actually get the break even 200,000 the same way. So we take 400 bikes, which is the break even units, times the sales price of 500 per unit, gives me 200,000 revenue sales. And that's the break-even sales. And that is the same as this break-even sales. So there's two different ways to get to the same answer. So let's come back to the margin of safety. So margin of safety says, what was the actual sales minus the break-even sale? That's the margin of safety. The higher this number, the safer we are of not getting closer to break-even. Break-even means we're not making any profits at all. So the larger the variance between actual and break-even, the more successful this company is, or the more safer it is from achieving their whatever target profit it is. Okay, so I've given you some examples here. Let's assume that this bicycle company had actual sales of 250, but their break-even sales is 200. The margin of safety is 50,000. Now, margin of safety can be expressed as a percentage, and it can be expressed as a percentage, 20%, but it's always the margin of safety divided by actual sales. So you can actually quote the margin of safety as a percentage or as a dollar amount. Okay? So let's take a look at this question. So now that we know what a margin of safety is, and remember, that was given to us. Margin of safety was given to us. So sales in dollars, we know that actual sales minus break-even sales gives you margin of safety. So the question gave us actual sales, right? The actual sales the actual sales is what we don't know, but we do know the break-even sales. The break-even sales is $250 times 2,700 units. Right? So that's X minus, to give us the margin of safety. And margin of safety, was that given to us? Yes, it was. It was 75,000. Okay, so now we can solve for X. So X minus 675 equals 75,000. X equals 750. So This is actual sales. Okay? So sales in dollars. Second, it's asking us for variable selling and admin. So let's take a look at this. We know that contribution margin percentage was given to us. So we've got sales less variable cost gives me contribution margin. And we know that contribution margin dollar, right? Contribution margin percentage is sales minus variable cost divided by sales. So we do know the contribution margin, don't we? That was 30%. So 30% equals sales, we just figured out. That was $750 minus variable cost divided by $750. So variable cost gives us $525. Now that we know the variable cost, that's a total variable cost, equals variable cost, manufacturing, so let's call it MOH, manufacturing overhead, plus variable selling and admin. So we do know the variable cost. Do we know the variable manufacturing overhead? Yes, we do. We know that's $80,000 plus the variable S&A. So solving for variable S&A gives us $525 Oh, I'm missing something. Hold on, I'm missing a variable cost isn't just the variable overhead, but I forgot to include direct material and direct labor, because those are variable costs, aren't they? And that we need to, that was given to us. So we need to add in there direct materials, which is 210, plus direct labor, which is 170. Completely forgotten about that. So let's recap. So we know that we were given contribution margin percentage and we just calculated the actual sales. So we needed to know what the actual sales were to be able for us to use it in the formula to calculate total variable cost. So this is total. Total variable cost, in this case, is made up of direct material, direct labor, variable manufacturing overhead, and variable selling and admin. So we know that that's the case. So we know that variable overhead, selling and admin, is $525, right, minus 80 minus 210 minus 170. So variable selling and admin equals 65,000. Okay, so that was the, let me just highlight that one because that's one of the required, and this is one of the things we had to solve as well. Okay? Next is asking us for fixed manufacturing overhead. So fixed manufacturing overhead was the next thing that they asked us to calculate. So let me put down fixed MOH. Now how do we calculate fixed MOH? Well, we do know the gross margin, don't we? In the question, we're given the gross margin. So sales minus cost of goods sold divided by sales gives us gross margin percentage. And that was given to us. Gross margin percentage is 22.5%. 0.50%. We do know the sales, don't we? 750 minus COG divided by 750. That means that cost of goods sold, so let's call it COG, equals 581,250. Okay? 581,250. So just do the math. Okay? Now, we do know that cost of goods sold is any cost associated with your manufacturing, which includes direct material, direct labor, plus variable overhead, MOH, plus fixed MOH, isn't it? And we know what variable overhead, right? We do know that. We do know direct material. We do know direct labor. So we do have all the elements, don't we? So 581,250 is our cost of goods sold. And that number, let me write this down. This number came from the calculation that we just did. Plus, what was direct material? Direct material is 210. Plus direct labor, 170. Plus variable overhead, was that given to us? Yep, 80,000. Plus fixed MOH. We can solve now for fixed MOH. And that gives us 121,250. So that's the answer. So for part 4, they asked us to calculate fixed selling and admin expenses. Okay, so we already know that total cost, fixed cost, equals fixed manufacturing overhead, which we calculated in part 3, plus fixed S&A expenses. So that's what this is, fixed S&A. So we know that total fixed cost. Now, how do we determine, how do we utilize the information that's given to us? We are given a contribution margin percentage to be 30%. We know that break-even sales equals fixed cost, total fixed cost divided by contribution margin percentage. So we know that at break even, sales less variable cost less fixed cost gives you 0 profit. Because we know the contribution margin percentage, which is sales minus variable cost divided by sales, then by switching this around, sales at break even is going to be fixed cost divided by the contribution margin percentage, and that's what we've got here. So, sales break even, we know it is 2,700 units times the sales price of $250 per unit. And we've already calculated that in part 1. In part 1, that is $675. Fixed cost is unknown. The contribution margin, we know that is 30%. So fixed cost is $675 times 30% to give us $202,500. That's total fixed cost. But we know that MOH we know that total fixed cost is fixed manufacturing overhead plus fixed selling and admin. This one we already calculated is 202,500. Fixed MOH, we calculated in part 3, if you recall. Part 3, we knew that that was 121,250. So we already calculated that. Plus FS&A, which is the unknown. So fixed, selling, and admin equals 81,250. Okay? So let me just highlight that. That was the unknown. Okay, we needed to calculate the 202 to tell us what the total fixed cost was for the entire. And how did we calculate the fixed cost? Well, we know what the contribution margin percentage is. That's 30%. And we know that the break-even sales, fixed cost equals sales minus variable cost. And we know that, so at least we know the break-even sale that was given to us in part 1. Now, part 5, the question asks us the earnings before income tax. Earnings before income tax. So let's calculate that. So this is part 5. Earnings before taxes. So we know that sales minus variable cost minus fixed cost gives you EBIT. EBT, right? Earnings before taxes. Sales, we know it's 750. That's the actual sales. Our total variable cost, we're able to figure that out, was 525. And that came from part 2. So this is part 1. Part 2. And total fixed cost, we're able to figure that out as 202,500. And that came from part 4. So EBT is 22,500. So these are the different parts that we're able to get these numbers from. Now, part B asks the question, what would be the sales volume that Fong needs to hit to achieve a $36,000 income after tax? Okay, so what we're dealing with here is the targeted operating income. So when the main objective of the organization is not to break even, then we need to figure out what target sales dollars we need to hit by using the following steps. So step 1 is determine the target operating income. In this case, we take the target income divided by 1 minus the tax rate. So we're told in this question that the 36,000 is after tax. We're going to take 36,000 divided by 1 minus the tax rate. And we're also told in this question the tax rate is 25%. So it's going to be 36,000 divided by 75% is our target operating income. Then we're going to add that to the equation to the fixed cost divided by the contribution margin per unit, as we did in step 4, except in part 4, your operating income was 0. But now we've got a target operating income to determine how many unit sales we need to hit. And then, or we can actually calculate the target dollar amount. So let's do that. So we know that the target EBT, okay, is 36,000. And we're going to divide that by 1 minus the tax rate to give us earnings before income tax. So this is income. This is target earnings. 36 divided by 1 minus tax rate to give us target earnings before taxes. In this case, it's 1 minus 25%. So earnings before tax gives us $48,000. Okay, so we know that it's sales minus variable cost minus fixed cost gives us target profit. Okay, or doing it differently, we know that fixed cost plus target profit give us target contribution margin, because this is contribution margin, isn't it? Okay, so all I'm doing is rearranging the formula, and we know the fixed cost. Do we know the fixed cost? Yeah, we do. That was part 4. Fixed cost was 202. This is from part 4. The target profit is 48,000. Gives us the contribution margin. We know the target contribution margin is 250, 500. So this one, the 48,000, we needed to do, and this is from part 4. Now, target sales equals contribution margin divided by contribution margin percentage. The contribution margin is 250, 500, divided by 30% as contribution margin to give us 835. Now, target units, it's as easy as taking the 835 divided by $200, $250 per unit. It gives us 3340 units. Okay, so it's a long about way to calculating the target sales and target units to get to a profit of 36,000 after tax. So we start with the profit after tax. We divide it by 1 minus the tax rate to give us the earnings before tax, or call it operating income. We take that operating income, we add it to the fixed cost to give us our target contribution margin. Just taking that same equation that we saw earlier, and we're going to use that to solve for the target contribution margin. Once we've got that target contribution margin, we're going to divide it by the contribution margin percentage to give us total targeted sales. And then we're going to convert that to number of units. Now, what is operating leverage? To calculate the operating leverage, which is part 2 of B, operating leverage, so operating leverage, the formula is contribution margin over earnings before taxes. And our contribution margin, we know it's 250, 500. Divided by earnings is 48,000 to give us 5.21 times. So that means that for every dollar increase in revenue, we're going to this helps us calculate how much of that increase is going to affect the operating profit. So in this question, the increase in sales is 8%. So to determine the increase in operating profit, we're going to multiply the 8% times the degree, so DOL it's called, times DOL of 5.219 gives us 41.75%. So that means that for increase in 8%, sales is going to translate to this much increase in operating profit. And that's the purpose of the degree of operating leverage, is that given the fact that our fixed cost is fixed, any increase in revenue is going to translate to a 5.21 times effect on the operating profit. Thank you.